State Farm General Insurance Company just abandoned California's homeowner insurance market, cutting loose 72,000 policies and triggering what might be the start of a massive nationwide insurance exodus. This isn't your typical business decision. It's a seismic shift that shows how America's biggest insurers are quietly backing away from entire states, leaving millions of homeowners scrambling for coverage they can't afford. When State Farm stopped writing new homeowner policies in California back in May 2023, industry watchers called it temporary. They got it completely wrong. What started as a pause turned into systematic withdrawal that picked up speed through 2024 and into 2025, ending in one of the most dramatic insurance market exits we've seen. The numbers paint a brutal picture. State Farm's California operation has been bleeding money at an unprecedented rate. By the end of 2024, the company's surplus had already dropped by over $300 million from the previous year, falling to just $1.04 billion. Then the January 2025 Los Angeles County wildfires hit like a knockout punch. Those fires alone triggered approximately 13,500 claims, forcing State Farm to pay out over $5 billion, with total expected payments reaching $7.6 billion. The financial impact was immediate and devastating. Another $400 million wiped from the company's surplus. State Farm General went from a relatively healthy financial position to watching its capital base evaporate in less than 2 years. The company's own words reveal their desperation. The swift capital depletion of State Farm General is an alarm signaling the grave need for rapid and transformational action. But here's what makes this story truly terrifying. State Farm isn't some struggling regional carrier. This is America's largest property and casualty insurer, a company with deep pockets and decades of experience managing risk. If State Farm can't make California work, who possibly can? The answer, increasingly, appears to be no one. State Farm's exit follows a broader pattern of major insurers fleeing California. Kemper subsidiaries announced their withdrawal in November 2023. Farmers' direct property and casualty insurance followed the same month. These aren't isolated incidents. They're part of a coordinated retreat that's completely transforming California's insurance landscape. The mechanics of State Farm's exit reveal just how calculated this withdrawal has been. The company didn't simply announce they were leaving and walk away. Instead, they implemented a rolling non-renewal process designed to minimize regulatory backlash while systematically shedding risk. The timeline was methodical. Homeowners policies began non-renewal on July 3, 2024, followed by commercial apartment policies on August 20, 2024. The 72,000 affected policies break down into distinct categories that show the scope of State Farm's retreat. Approximately 30,000 policies covered homeowners, rental dwellings, residential community associations, and business owners. Another 42,000 commercial apartment policies were also terminated. While these numbers represent just over 2% of State Farm's total California policy count, they signal something much larger than their percentage might suggest. What's driving this exodus? State Farm has been remarkably candid about the factors forcing their hand. Inflation has made construction costs unpredictable and expensive. Natural disasters have become more frequent and severe, with wildfire seasons now extending year-round. Reinsurance rates have skyrocketed as global insurers reassess California's risk profile. Here's the critical detail that explains why reinsurance matters so much. State Farm General's surplus stood at just $1.04 billion heading into 2025. The January wildfires generated $7.6 billion in expected claims, losses that would have wiped out that surplus more than 7 times over. The only reason State Farm survived was their reinsurance coverage, which absorbed the bulk of those catastrophic losses. But reinsurance isn't free, and as those costs climb, insurers pass them directly to consumers through higher premiums, assuming regulators allow it. But perhaps most significantly, State Farm points to decades-old insurance regulations that prevent them from charging premiums that reflect actual risk. California's regulatory environment has created a situation where insurers are required to provide coverage at rates that virtually guarantee losses. It's a business model that simply doesn't work when catastrophic events can wipe out years of premium income in a single season. The regulatory friction became particularly evident when California's insurance commissioner rejected State Farm's request for interim rate increases in 2024. The company's response was unusually blunt, stating the rejection sends a strong message to State Farm General about the support it will receive to collect sufficient premiums in the future. This regulatory standoff illustrates a fundamental disconnect between how insurance companies need to operate and how California regulators expect them to behave. Insurers argue they need the flexibility to price risk accurately and adjust rates quickly as conditions change. Regulators, facing political pressure from consumers already struggling with housing costs, resist rate increases that could make insurance even less affordable. The human impact of this standoff is becoming increasingly clear. When State Farm non-renews a policy, homeowners don't simply lose their insurance, they're forced into a market where alternatives are scarce and expensive. One affected customer found themselves paying $6,800 annually for surplus carrier coverage after State Farm's non-renewal, a rate that would have been unthinkable just a few years ago. Many displaced policyholders end up in California's FAIR Plan, the state's insurer of last resort. The FAIR Plan was designed to provide basic coverage for properties that can't find insurance in the voluntary market, but it was never intended to handle the volume of applications now flooding in. Following the January 2025 wildfires, California's insurance commissioner approved a $1 billion FAIR Plan assessment, highlighting just how strained this safety net has become. The timing of State Farm's announcement reveals the strategic nature of their withdrawal. The company formally notified the California Department of Insurance on March 20, 2024, in a detailed letter outlining their plans. This wasn't a snap decision made in response to a single catastrophic event. It was a carefully planned exit strategy that had been in development for months. Even more telling was State Farm's response to the January 2025 Los Angeles County wildfires. Faced with massive losses and intense public scrutiny, the company paused homeowner non-renewals in Los Angeles County and allowed previously non-renewed policies from January 7, 2025 to renew. While State Farm framed this as a goodwill gesture, the move came after Insurance Commissioner Ricardo Lara imposed a mandatory moratorium on non-renewals and cancellations within wildfire perimeters. The reversal was less a voluntary tactical pivot and more a recognition that defying the state's insurance regulator during a catastrophic disaster would invite far greater regulatory consequences down the road. California Deputy Insurance Commissioner Michael Soller's response to State Farm's exit reveals the regulatory community's growing concern. His statement that State Farm General's decision today raises serious questions about its financial situation suggests regulators are beginning to recognize that this isn't just about one company's business strategy. It's about the fundamental viability of property insurance in high-risk areas. The collaboration between California regulators and Illinois insurance officials reveals that this situation has moved beyond typical state-level oversight. When regulators start coordinating across state lines to monitor an insurer's financial condition, it signals that the implications extend far beyond California's borders. State Farm's strategic approach involves difficult decisions to attempt to responsibly limit overexposure in high-risk areas, while allowing for targeted growth in lower-risk areas of the state. This language suggests a complete reimagining of how insurers will operate in California going forward, cherry-picking the safest risks while abandoning areas where losses are predictable and severe. The broader industry implications become clear when you consider the precedent State Farm is setting. If the nation's largest property insurer can't make California work under current conditions, smaller companies face even steeper challenges. The domino effect is already visible, with multiple carriers following State Farm's lead and exiting the market entirely. This pattern mirrors what's happening in Florida, where similar dynamics have created an insurance crisis that's reshaping the entire property market. Hurricanes, regulatory constraints, and litigation costs have driven dozens of insurers out of Florida, creating a template that California seems destined to follow. State Farm's statement that they continue to evaluate the need for any additional business actions as market conditions change is perhaps the most ominous aspect of their California exit. This language suggests that what we've seen so far may only be the beginning. As climate risks intensify and regulatory environments remain inflexible, Further contractions seem inevitable. The implications extend far beyond insurance. When major insurers exit a market, property values decline, mortgage availability decreases, and economic development slows. Communities that lose insurance access face a cascade of economic consequences that can persist for decades. California's situation is particularly concerning because it represents a perfect storm of factors that exist in many other states. Wildfire risk is increasing across the American West. Hurricane exposure is growing along the Atlantic and Gulf coasts. Tornado activity is intensifying in the Midwest. The regulatory and financial pressures that drove State Farm out of California are present, to varying degrees, in markets across the country. State Farm's California exit isn't just about one company leaving one state. It's a preview of how the insurance industry will respond to increasing climate risks and regulatory constraints nationwide. The company's systematic, calculated withdrawal demonstrates that even the largest insurers have limits to their risk tolerance. As other states watch California's insurance market unravel, they face a critical choice: adapt their regulatory frameworks to accommodate the new reality of climate risk, or prepare for their own insurance exodus. State Farm's actions suggest that the industry won't wait for regulatory evolution. They'll simply move to markets where they can operate profitably. The silent nature of State Farm's exit, implemented through rolling non-renewals rather than dramatic announcements, may become the template for future market withdrawals. By the time regulators and consumers fully grasp what's happening, the damage will already be done, leaving millions of Americans to navigate a world where property insurance is either unavailable or unaffordable. California's insurance crisis is just the beginning. State Farm's methodical exit strategy provides a roadmap that other insurers will likely follow as climate risks intensify and regulatory environments fail to adapt. The question isn't whether this pattern will spread to other states. It's how quickly it will happen and whether anyone will be prepared for the consequences.